who's coming in. Okay. And if
Okay,
no one comes in, that's fine because it makes it easier when no one's on Zoom, you know?
I got the, all right, they took the practice session down. So.
Yeah. So I came down and then I'm live streaming now. Uh, mm, mm.
Right, somebody just emailed me for the link, so we should get one person anyway.
I'm looking for the record.
I heard a message saying it's being recorded.
Yep. Okay. It's being recorded. So I'm probably going to have to edit this out. Okay. Okay. So yeah, don't send them your link because that's the panelist link.
Oh, okay.
Okay, I'm going to start.
Oh, you know what? That link is, I did send a panelist link to somebody, so that's not going to work. Hey, Rob, can you sign out? I sent you the wrong link. I'll send you a different link.
Because Rob's being broadcast to LinkedIn.
Okay, Rob, could you sign out? I'll send you a different link because otherwise you're going to be on the video. Okay.
Okay, we had that little snafu there, but that's okay. Hello, everyone. Welcome um, to Conversations with Rudy Rivera. So good morning, good afternoon, or good evening, wherever you are in the world. Um, I'm really excited to talk about a subject that I know to me it's exciting, can sound boring to some people, but Fred and I are going to make it interesting. And that's about the Federal Reserve. You know, what is it? What does it do? We've seen so much in the news about the Federal Reserve that Fred and I got to talking, and I said, well, can we talk about what it does? So with me is Fred Egler, who has a very illustrious career as head of litigation for PNC Bank, general counsel for ServiceLink, was a partner in a large law firm, and is now working as an expert witness in the financial services industry. Fred, welcome.
Thanks, Rudy.
So, Fred, tell me, what is the Federal Reserve?
Uh, I recently wrote an article about this because there has been so much mention of the Federal Reserve lately in the news. And most people who hear about it assume that it's a bunch of people that get together once a month or so, talk about interest rates, issue a press release, and then go off and give a lot of boring speeches. Uh, the the other thing that they may have heard is that President Trump is trying to fire one of its members. But other than that, I think most people have really no idea what the Fed does because it's a very large, complicated organization. It has effects on just about every part of our lives because it is the central bank for the United States. So I thought it would be good today if we could spend some time talking about uh, how the uh, how the Fed works, what it does, and and how it affects the average person. So if with your permission, I'll share my screen.
No, go ahead. And most people, when they think about the Federal Reserve, they think about just interest rates, but it's more than just that.
Well, that's right. This first slide here is from the Federal Reserve website, and besides showing you a picture of the building in Washington, it also gives a brief description of everything the Fed does, which is conduct monetary policy, hopefully to manage inflation and unemployment, to promote financial stability by making sure that banks remain safe and sound, to run the payment system in the US that clears checks, wire transfers, and other forms of payment, and to protect consumers and promote community development, which are other things that Congress has directed the Fed to do. It would be helpful, I think, to go back and take a look at the history of the central banks in the United States. The US, or at least a number of people in the US, have always been somewhat suspicious of the idea of a central bank. Alexander Hamilton founded one when the Republic was born, but it was abolished by Andrew Jackson in 1836. And after that, banking became pretty much the province of the states. And during the 19th century, you could not get paper money that was issued by the federal government. If you wanted paper money, it would look like this. It would be issued by a specific bank in a specific state. These are some examples. There were a couple of problems with this. One was liquidity. If you had a $100 bill from a bank in Cleveland and went into a bank in St. Louis and or went to a store in St. Louis, the store might not be willing to honor it for $100. They might say, well, that bank's in Cleveland. I don't know anything about it. I'm only going to give you $95 for this. So that was a problem. The other problem was that there were a lot of banks. Branch banking was illegal at that time in most states, and there were thousands of banks. And a lot of them went bust. And when they went bust, you had what we called a panic that I think most people are familiar with, where the bank does not have enough money to pay off its depositors. People find out about that. They try to withdraw more and more of their deposits, and the bank goes out of business. This recently happened to a very large bank in California called Silicon Valley Bank. And if you remember, Rudy, you and I talked about that in a previous podcast. So this finally reached a crisis point in 1907 when there were a number of large banks that were on the verge of failing, and the government realized that the financial system was on the verge of collapse. But there was no one to bail out these banks because there was no central bank. So the government turned to one very rich individual, J.P. Morgan. Yes, the same guy that the big bank today is named after. He was the richest man in the United States. And he agreed to put up enough money in circulation to keep all the other banks solvent to prevent a financial collapse. After that happened, people realized it wasn't a good idea to rely on one guy to bail out the whole financial system. So after Woodrow Wilson was elected president in 1912, Congress passed the Federal Reserve Act in 1913, and that's pretty much the same system we have today. So here's how it works. The Federal Reserve, quote unquote, is actually 13 different entities. It's 12 Federal Reserve district banks, each one a separate district covering a separate part of the country with a separate board of directors. Then in Washington, you have the Board of Governors of the Federal Reserve. Those are 7 directors appointed by the president and confirmed by Congress who serve for 14 years. They, in turn, appoint some of the directors of the regional banks, but the rest of the regional bank directors are actually appointed by the commercial banks that own stock in those banks. So it's a combination public-private system, and that was done because many people in Congress were suspicious of one giant bank that would run everything. So that's why we have 12 different Federal Reserve district banks. And after that, the central bank started issuing federal currency that we're familiar with today called Federal Reserve notes. Now, because these notes were backed by the government, federal government, pretty soon all those old bank notes that we looked at a minute ago fell out of favor. Nobody wanted them anymore. And today you could use them as wallpaper, but they don't have any value. But Federal Reserve notes, when they were originally issued, were backed by gold and could be exchanged in gold.
Were they ever backed by silver?
Gold and silver, yes. First, originally just gold, but then later silver. And you had the right, at least theoretically, to go in and exchange it for a equal amount of gold. The U.S. actually stayed on the gold standard until Nixon took it off the gold standard in 1972.
And
But
why was that? Because gold was too volatile?
well, it was because of yet another international agreement called Bretton Woods, in which currency, all foreign currencies of all big countries were linked to the value of the dollar by a preset formula. And the value of the dollar in turn was linked to gold. And what happened was uh, we started to have inflation in this country, and people realized that they could exchange gold for dollars in the US and go sell it for a lot more money somewhere else. So US gold reserves started to get rapidly depleted. So Nixon just abrogated the gold standard and said from now on, basically, the US money is worth what the Fed says it's worth.
I
Uh,
noticed it's $100,000 bill that you have on your screen. Do we still have those?
No, this bill never actually circulated. This bill was used to transfer money among Federal Reserve district banks, but there were $1,000 and $500 bills as late as the 70s. Today, the largest circulation bill is the $100 bill. And an interesting fact about that is a majority of US $100 bills in the world circulate outside the United States. Many people, many countries with high inflation, Argentina is a good example. Rudy, you may be familiar with this, keep shoe boxes of $100 bills because they're afraid that the Argentinian peso will be worthless, and so they'll have something to fall back on.
Yeah, I've heard from some of my Argentine colleagues that, a Coke will cost you $1 one week, the next week it'll cost you $1.50. It changes so much, so you don't want to keep the local currency for that reason.
Yes, and that's true in many countries. Many countries hold, many people in many countries hoard U.S. currency, and of course, it's also used for illegal transactions, or at least it was until Bitcoin became popular for that. But anyway, after 1913, the Fed started uh, operating, and of course, what we're most familiar with in terms of the Fed operations are this man, who I think is probably much more recognizable than he'd like to be right now, Jerome
Probably more
Powell.
recognizable than other Federal Reserve chairmen.
Yes, Jerome Powell. He's the chair of the Board of Governors of the Federal Reserve. And as I said, the governors are appointed for a term of 14 years. However, the chair is appointed for 4 years. The governor's terms cannot be renewed once they serve 14 years or out, but the chair's term can be renewed after a term of 4 years. Now, President Trump has made it clear that he's not going to reappoint Chairman Powell, although some people forget Trump appointed Powell in the first place, but obviously he's changed his mind. And this is a picture of Powell at one of his press conferences, which have become kind of famous because the Fed issues a press release announcing what they are or aren't going to do with interest rates. Then he has this press conference and everybody hangs on every word he says. And the stock market can go up or down, thousands of points, depending on what he says or what he doesn't say.
But
But
Fred, go into the decision it takes to set the interest rates, because many people think, I used to think, that the chairman says, oh, interest rates are going to be this now, and they're not. What's the decision process there?
well, let's talk about the mechanism. The Fed manages monetary policy, which is what people think of as setting interest rates, through a committee called the Federal Open Market Committee. And it consists of the chairman, Powell, the other members of the Board of Governors, so that's a total of 7 Board of Governors, and then the chairman of the board of the New York Fed, the Federal Reserve Bank in New York, who is a permanent member, and then the chairs of 4 of the other 11 district banks, and they serve on a 1-year rotating basis. So those 4 rotate through. So that's the organization that makes the decision. How do they make their decision? Well, it's important to look at it looking backwards and looking forwards. Looking backwards, the Fed collects all this data. They have all these economists that do all these projections and assumptions, and based on what the data is, the money supply is too tight, and therefore interest rates should be lowered, or the money supply is too loose and there's too much inflation, so therefore interest rates should be tightened. And based on that, they make a decision. But the decision is also forward looking because every time they announce a decision, they also announce their projections for the next couple of years. And they do that with what's called the dot plot, which is just what it says it is. It's a series of dots plotted on a chart, and each dot represents a prediction by each member of the Fed Open Market Committee as to what interest rates, inflation, and unemployment will be like in a month, 6 months, a year, 2 years. The reason they do that is that they want the financial markets to have a good understanding of what they're going to do. Because what they don't want is to announce their decisions and surprise the markets, because that can cause big problems. For example, the Fed just lowered interest rates by a quarter point a couple of weeks ago, and the stock market didn't react at all. Stock
Why,
market didn't.
why do you think that is?
Well, because the Fed had communicated in advance, both by this dot plot and also by these speeches that they're constantly giving, that what they were going to do. So it came as no surprise. And that's what the Fed likes. The Fed really wants the market to do its work for them. It wants the market to adjust to the interest rates set by the Fed, so that what the Fed is doing is really what just confirming what the market expects all along. But let's talk a little bit about what quote unquote setting interest rates actually means. The Fed doesn't just come out with a statement saying interest rates are 4% and everyone says, oh, okay. They actually have to do it through what's called open market operations. And these are all done by the Federal Reserve Bank in New York. And this slide shows how it's done. The Fed will put out tenders or offers to buy bonds at a certain amount. And then it will buy the bonds and send the money to the broker. The broker then deposits the money in the bank. Now, that does two things. First of all, we're talking about a situation now where the Fed wants to lower interest rates. That makes the price, because the Fed is buying, it makes the price of short-term instruments cheaper, and that means a lower effective interest rate. And also, it puts more money in the banks for banks to lend, which means that banks will lend money at a lower interest rate. So that's what it means when the Fed lowers interest rates. What's important to realize here, though, is that this is all a very short-term thing. This operation here really can only directly affect instruments that have a term of 6 months or less, so-called short-term interest rates, instruments rather. So when you hear that the Fed is lowering interest rates or raising interest rates, they're not raising long-term interest rates, they're raising short-term interest rates. It's not at all unusual, for example, for long-term interest rates to go up when the Fed lowers short-term rates. There's a lot of other factors at work there, but most of them have to do with the interest rate paid on longer-term bonds, especially 10-year bonds. Now, the Fed does do something else to try to affect monetary policy. It's called quantitative easing. You may have heard about this. This is a little more complicated. And this is when the Fed just goes out and buys long-term bonds and other things. Sometimes they buy stocks. And this puts more money into the economy and, at least in theory, lowers long-term interest rates. However, it also has the effect of putting all these securities on the Fed's balance sheet. Right now, the Fed's balance sheet is trillions of dollars more than it was before COVID, when it really exploded. And so now the Fed is engaged in something called quantitative tightening, where they sell stocks and bonds, which pulls money out of the system, reduces the money supply, and should, at least in theory, raise long-term rates. Though that hasn't really happened, mainly because even with the Fed's purchases, the economy is so big right now that it's very difficult for the Fed to have any effect on long-term interest rates. But it's important to remember that there's only so much the Fed can do. Like, the Fed is supposed to maintain a balance between unemployment and inflation. You don't want either of them to be too high. And so when unemployment is too high, the Fed is supposed to cut interest rates. But the Fed can only cut interest rates so low. I mean, the great example, of course, is COVID. Unemployment shot up, and the Fed lowered interest rates to zero. But unemployment still stayed high for a while because the Fed can't lower interest rates below zero. So there's only so much they can do. And
right. The interest rates at one time were like 2.3%. Now they're at 6 and 7 and higher.
Well, interest rates, we were in a low interest rate environment for many years. And there's a lot of different reasons for that. A lot of it has to do with what happened during the great financial crisis. But yeah, although people complain about 6% mortgages and 4% short-term interest rates, those are actually much closer to historical interest rates than what we've experienced over the last 5 or 10 years.
Well, in the 1980s, Fred, 1980, when I graduated from law school, interest rates shot up to 18%.
I bought my first home in 1983. I remember I got a purchase money mortgage from the seller for 9%. And I remember thinking that was such a good deal that I would never see a rate that low again. Well, of course, that was the highest rate I ever paid. So it's very unpredictable. But the as I said, the big thing the Fed tries to do is to be very transparent about what its intentions are and whether or not it thinks rates are too high or too low and when they think they should be cut. And that's why you see these Fed governors, the members of the board, and Powell giving speeches all the time. They're constantly giving speeches. And that's because they want people to, the market to understand the way they're looking at things. And frankly, they want people to tell them if they think they're wrong, because if they are, they have an open mind and are willing to change their mind. Most of these Fed governors have long histories in private banking, and so they understand how banks work, how the financial system works, and they're willing to listen to other bankers. And so the decision to raise or lower rates is something that the Fed takes with a lot of caution and care because, number one, it can have such a big effect on the economy, but also, number two, it's already set expectations in the financial markets for what it's going to do, and it does not want to change those expectations.
Well,
But with all, even with all, okay.
The current administration wants the Fed to lower the interest rates. And there's some resistance. There was some resistance. I realize it was lowered half a point, but I think the current administration is trying to make it sound easier than it really is. Just lower the interest rates and everything will be fine.
Well, one of the problems with doing that is that it would call into question the independence of the Fed. So another term that's been thrown around a lot. And what Fed independence means is that the Fed is supposed to act without express direction by the president or the Treasury Department. Now, that is not a statutory requirement. That is something
more historical than anything else.
Right. Fed independence really didn't exist until the Truman administration. Before that, like, for example, during the Great Depression, when the Fed existed and was severely criticized for not doing more things to expand the money supply, the Fed just did what the Treasury Secretary, who at the time was Andrew Mellon, told them to do. They weren't independent at all. But after the Second World War, Truman and his Treasury Secretary decided that it would be better if the Fed acted independently. So there's a agreement between those two departments that sets that out, but that could be revoked at any time. However, lowering interest rates abruptly after the president tells you to do it may not have the same effect that many people expect it to have. For example, one of the things it would do is it would cause a great loss of confidence in the US dollar. Because if all of a sudden the Federal Reserve said, well, we're going to cut interest rates 2% because the president told us. Well, of course, when interest rates go down, the value of the dollar falls because you can't buy dollar-denominated instruments with interest rates are as high as they were before interest rates were cut. And so the dollar always falls at least a little bit when interest rates are cut. But the dollar usually maintains its value because people have confidence in the Fed and in the US government that it's going to maintain the currency. It's not going to devalue the currency. So if interest rates
be subject to political whims, in other words, it's just
right. So if interest rates were
analysis, yeah. I'm sorry. Go ahead.
If interest rates were cut abruptly as a result of a direct request by the president, that could lead to a significant loss of confidence in the dollar. And if that happened, then Treasury bonds, which are by far the biggest source of credit in the country and in the world, the rate on Treasury bonds would go up because people would want more interest to buy the treasury bonds because they would be afraid that the government would continue to devalue the currency, and therefore the dollars they got back when their bond matured would be worth less. So it could have just the opposite effect of what the president wants. All that remains to be seen. But I'd like to move on and talk about some of the other things the Fed does.
Go ahead, Fred. Yeah.
So one of the most important functions of the Fed is to function as one of the principal financial regulators in the United States. The Fed has oversight over a large number of different types of financial institutions. Now, here's a diagram from the Federal Reserve website that provides some information about this. We have this kind of alphabet soup type of regulation of financial institutions in the U.S. Everybody's heard of the FDIC, the OCC, the SEC. This chart mentions the NCUA, which is an organization that regulates some savings banks and credit unions. So there's all these regulators. But you can see here that the Fed regulates by far the largest number of organizations. The Fed regulates all bank holding companies. Now, what a bank holding company is if you say, well, I want to buy stock in PNC Bank, and then you go buy stock in PNC Bank, you're not really buying stock in the bank. You're buying stock in a bank holding company. In that case, it's called PNC Financial Services Corporation. And that company has stock that's listed on a stock exchange. And that company, in turn, owns the bank. But because those companies can do things other than own banks, the Federal Reserve regulates them to make sure that they have enough capital and that they are safe, their assets are safe so that they do not end up dragging the banks they own down with them in the event that the holding company or its stock runs into trouble. The Fed also regulates what are also called non-bank subsidiaries of bank holding companies. For example, many bank holding companies have other organizations that issue securities. Most bank holding companies have a separate organization that will issue notes and bonds, for example, to obtain additional capital. The Fed regulates them. The Fed also regulates foreign banking organizations that have banking operations in the United States. If you go to New York City and walk down the street, you'll see the offices of many different foreign banks.
Bank of China, Bank of Singapore, Bank, Argentina.
Right.
Banco
And
Central.
to the extent those banks are lending money and taking deposits in the United States, they're under the jurisdiction of the Federal Reserve. The Federal Reserve still regulates some savings and loan holding companies. There's still a few of those around. And then they also regulate certain organizations that are called financial market utilities. These are organizations that nobody's ever heard of, but that the financial system couldn't exist without. And I'll just mention one of them. One of them is called the DTCC, the Depository Trust Clearing Corporation. And this is an organization that holds all the stocks and bonds that are traded in the United States. And when you make a trade, you think you're trading with your broker, but actually all you're doing is getting a promise from your broker that he's going to buy or sell that share of stock. And then he goes to an exchange to sell it. But the actual securities are all held by the DTCC. So it's a very important organization. And there are other organizations like that too.
Fred, in your article, when you talk about the Federal Reserve having jurisdiction over banks, and your article 2023, they issued like $500 million worth of fines.
Yes, the Fed has a lot of power. It can shut down the bank. It can force it to adhere to specific regulations. It can prevent it from acquiring other banks. It can put a ceiling on the amount of deposits that it can take. And it can impose fines and bar its directors and officers from ever working for a bank again. Many of those penalties arose out of fraudulent activities that these banks were engaged in, primarily individuals who were authorizing loans to companies that they themselves had interests in, things that were blatantly improper.
Fred, we have a question. Where is the DTCC located?
It's in New York City.
In New York City. Yeah. Well,
The
go ahead.
what you described, the imposition of penalties, is an important function of the Fed. We refer to that as their enforcement function, but a much more important function is their examination function, which is basically bank examiners who oversee banks and bank holding companies and try to prevent these problems from happening in the first place. And one of the big ways that the Fed does this is through capital management. Banks and bank holding companies have to maintain capital. And again, Rudy, we talked about this in a prior
Yeah, which is why they have
podcast.
to unload their loan portfolio too to get capital back in.
Right, exactly. But every year, the largest bank holding companies submit to what are called stress tests, where the Fed presents them with scenarios saying, well, what if unemployment were 20%? Or what if interest rates rose by 15%? Or what if the federal government defaulted on its obligations? What would happen to you? Would you have enough capital to survive, or would you go broke? And then they have to prove to the Fed that they are holding enough capital to survive an extremely severe event. And those stress tests are the way that the Federal Reserve requires banks to hold capital. I should mention also that it's not necessary that to become a bank holding company that you own 100% of a bank. If you own as little as 25% of the stock of a bank, you can be considered in control of the bank. And then you're a bank holding company and you have all these other obligations. And so you see many investment companies being very careful not to buy more than a certain percentage of the shares of banks because they don't want to subject themselves to Fed regulation.
Well, Fred, the question though is the Fed may have been dropping the ball on banks in Puerto Rico because it seemed that there were 4 or 5 of them that went under. The FDIC took them over. Doral Bank, Western Bank, Euro Bank. There were a couple other banks that were seized. When what's the FDIC's role in this? Does the Fed say, FDIC, we're going to take over this bank and gives instructions to the FDIC?
Well, the FDIC has several functions. First of all, it operates the Deposit Insurance Fund, which is the fund that guarantees the
Mhm.
deposits of depositors up supposedly up to $250,000, although we've seen they've actually paid out a lot more of that in recent years in what are called federally insured depository institutions, FIDIs, which are an important category. Second, the FDIC has supervisory authority over a lot of other state chartered banks, and they go out and examine these banks and attempt to ensure that they are operating in a safe and sound fashion. And third, the FDIC is responsible for what's called resolution, which means that when a bank does fail, the FDIC comes in, takes over, and usually tries to sell what's left of it to another bank in order to avoid having to pay every last dime out in deposit insurance, but makes some effort to try to resolve or rehabilitate the failed bank. The FDIC also goes out and sues other people who they think are responsible for the failure of the bank. But that's basically what the FDIC does. The FDIC does not supervise holding companies. That's the important distinction. The FDIC operates at the bank level. The Fed operates for the most part at the holding company level.
Okay. That's an interesting distinction. I never realized that before.
Yeah.
But go ahead.
Well, I was going to move on to just one other point on bank examination. The Federal Reserve spends a lot of time dealing with the operations of foreign banks, and a big part of that is figuring out exactly who those foreign banks are lending to and who their customers are, because many of these banks can end up with relationships with customers that are people that the United States does not want banks dealing with, either money laundering problems with criminals or lending money to unsavory people in other countries. Or, in other words, what the Fed wants to prevent is foreign banks using their access to the U.S. financial system to funnel money to foreign nationals who banks are who are not acting with the best interests of the United States in mind. So that's another thing that the Federal Reserve does.
What's the difference between the Federal Reserve and FinCEN? Because I noticed that FinCEN just declared three financial institutions in Mexico as accomplices in money laundering for drug cartels.
So FinCEN is not a government agency. Uh, FinCEN is an organization that is allowed to regulate certain types of financial organizations because of permission from the SEC. And FinCEN in particular has responsibility for regulation of broker dealers in the United States. And
Okay.
so if you are a broker dealer in the United States, for the most part, there are some exceptions, but for the most part, you have to be a member of FinCEN. And when you join FinCEN, then you agree to, number one, abide by FinCEN rules, and you consent to the jurisdiction of FinCEN enforcement, which is allowed to impose sanctions on you, throw you out of the industry, and various other things. But that is actually a self-governing organization. Those people, on the one hand, if you want to operate, you have to join it. But once you've joined it, you're subject to their jurisdiction. And what FinCEN was doing there is basically, they don't have any jurisdiction of these organizations in Mexico. What they're saying is to their members, you can't deal with these people.
That's exactly what happened to three financial institutions, and other institutions took them over or are in the process of taking them over.
Right. Well, if you were a broker dealer in FinCEN, you could said nobody could deal with them, you'd be out of business. So,
Right. Well, that's exactly what happened. They're all being sold and parceled off.
yeah. And on this subject of Fed regulation, I think it's worth pointing out, as I mentioned earlier, though everybody thinks, the Fed and interest rates have so much power, that the Fed has a tremendous amount of power over the financial system through this regulatory function. They approve all mergers. They approve the ability of bank holding companies to get into other non-bank activities. They approve, as I mentioned earlier, these capital plans that require banks to hold a certain amount of capital to operate. Banks are required to comply with numerous other regulations about who they can lend to, how they can lend to, how they maintain what kind of deposit product they can offer. Your experience in a bank with a bank is very much affected by the Federal Reserve, whether you realize it or not. So let's
Fred,
talk. Go
go
ahead.
ahead. No,
Well, let's.
we're going to talk about the discount window. That's another thing that fascinated me.
That's where I'm going next, to the next function of the Federal Reserve. And this is the function that was really absent during all these bank failures and panics in the 19th century, and what really caused the government to finally establish a central bank. Is the Federal Reserve is a lender of last resort. What that means is you can think of it as a bank for banks. Banks can be caught in what's called a liquidity squeeze. We talked about this with Silicon Valley, because in the United States, banks practice what's called fractional reserve banking. When you go and deposit your $1,000 at the bank does not take the money and put it in a drawer somewhere. They lend it out to somewhere else. And based on the experience, they keep in reserve a certain amount of money that they think will be sufficient to honor the amount of deposits that have to be paid out on a given day. Now, if they're wrong, they can go borrow money from other banks. They can do other things to supplement their liquidity, but they can get into a position where they're so illiquid. In other words, where their borrowers aren't paying them back, their depositors are taking out all their money, that they're running out of money and running out of liquidity. In other words, they might still have assets, but they're running out of liquidity. And in that situation, the Fed offers multiple different programs that will allow these banks to borrow money in a panic situation. The most famous one is the discount window. The discount window, basically, it's famously described as lending freely at a penalty rate on good collateral. And what that means is the bank pays an above market rate. The bank needs to pledge high quality collateral. Usually it's government securities. And in exchange for that, they get immediate liquidity. Now, you might say, well, why doesn't the bank just sell the government securities to get the cash? Well, there's two reasons. First are they might take a loss in the securities. Second is, as soon as they start selling their assets, people are going to know about that, and they're going to lose even more of their faith in the bank, and they're going to withdraw more and more of the money, and it'll just be a downward spiral. So the discount window is basically a life raft to banks that are having short-term liquidity problems. It's not intended as a way to restructure a bank to say, oh, well, now I'm going to stay in business because I'll just borrow my money from the discount window. No, it's a short-term liquidity function, but it's a very important function. For a long time, banks were not borrowing from the discount window at all because of the stigma that was associated. Because discount window borrowings are public. They're on a delay of a couple of months, but you can figure out who's borrowed from the discount window. And there was a concern that people would look at that and say, oh, well, this means this bank's not in good shape, so therefore I'm not going to deal with it. But that has really abated. The Fed has done a lot to try to encourage banks to use the discount window more. And during the Silicon Valley crisis, there were at one point, there were almost $150 billion in borrowings outstanding from the discount window. So that has changed quite a bit. But in addition to that, the discount window, the Fed has all these other programs, as you can see, this is a page from their website, that allow banks to borrow from it. You may remember this Paycheck Protection Program liquidity facility, which was a facility that allowed banks to offer loans to their customers in order to maintain people on payroll. And the Fed provided liquidity for that. There was also this bank term funding program that was in effect right after the demise of Silicon Valley Bank, at which banks, one of the problems with Silicon Valley is that, and many other banks, is because of the rise in interest rates, they had bonds that they had taken out that paid like 3%, and now interest rates were like 7%, so the bond was worth much less. So let's say the bond's worth 60% of its face value. Well, this facility would allow, under this facility, the Fed allowed these banks to borrow at 100% of the value of the bond, the face value of the bond, even though the market value was less. And that also was a big liquidity aid to banks. That facility has been shut down. But the Fed offers all these different ways to provide liquidity for banks. And I'd like to talk about another one that is frequently mentioned in the news called repurchase agreements. This is a confusing name because a repurchase agreement is really a loan. So what a repurchase agreement is let's say I need cash, let's say I'm a bank and I've closed the books for the night and I realize that I need $10 million to honor everything I have to pay out that day. And so then I go to somebody else and say, look, I have $10 million in treasury bills. Why don't you buy those from me at 105% of their face value, and I'll repurchase at 100% rather, and I'll repurchase them from you at 105% of their value the next day. That's a repurchase agreement. Now, what that is,
what's the reason for that? What's the reason for that?
The reason for that is it provides immediate overnight liquidity. The selling bank takes the cash, immediately uses it to fund its obligations, and then the next day it has its assets. It has its bonds back. And so the Federal Reserve has been running this type of facility for years. So what happened was, over the last few years, the Fed has greatly increased the amount of reserves that it encourages banks to hold. So the problem the banks have now is not that they don't have enough liquidity. They have too much liquidity. They have all this cash lying around. They don't know what to do with. So that has created. They could
loan it to people.
Well, there was not enough demand for loans. And so what they would do is, and this was not just banks, I'll come back to that in a minute. They would go to the Fed opened up a reverse repurchase agreement. Again, one of these titles that is unnecessarily complex. But what it says is that the Fed says, I will sell to you a bond at 100%, and then the next day, you will give me $100 for that bond. Then the next day, I will give you the cash back at 105%. And so the bank now has a yield on its funds, whereas before it didn't have that yield. This became a big practice with money market funds. They're one of the big users of these reverse repurchase agreements because they can get a more, there's just not enough short-term instruments out there, believe it or not, for the money market funds to park all this money. So they send it to the Fed. The Fed keeps it overnight, and then sends them a bond. Then the next day they send the bond back, and the Fed sends them back the money with interest. And although these are described as overnight agreements, in fact, these just get renewed over and over and over again. So you can have repurchase agreements. You can have people in a position where they're short. In other words, they need money, so they're doing repurchase agreements, or they're long. They don't need the money, and they're sending out the money to the Fed overnight for months on end. And one of the things the Fed looks at, by the way, when they're deciding whether or not to raise interest rates, is the size of these arrangements. So, like, for example, if the bank is taking in too much cash, or if the Fed is taking in too much cash overnight on these overnight repurchase agreements, they're going to say, oh, well, this is ridiculous. We have to, the interest rate, the money is just too loose. We have to tighten up and raise interest rates. So the next thing I want to talk about is the Fed as a payment processor. And this is another thing that people do not understand. People don't really understand that if you get a check from Bank of America and deposit it at PNC Bank, that check is almost certainly going to go through the Federal Reserve, because the Federal Reserve acts as what's called a clearinghouse for checks. And what that means is the checks that are deposited in one Federal Reserve district, let's say in the Pittsburgh branch is Cleveland, all the checks deposited in banks in Pittsburgh that are drawn on checks in other parts of the country will go to the Federal Reserve Bank, and the Federal Reserve Bank will send them to the other Federal Reserve banks, and those other Federal Reserve banks will then send them to the banks on which the checks are drawn. And that happens every night.
But that's to me, what that is a glorified accounting system. So in other words,
well, but yes, except that
but
there is credit risk.
Yeah.
Banks, people bounce checks, banks fail. And so, all along that way there, somebody is accepting credit risk. Remember when I said earlier, when we were talking about the old days when local banks issued their own notes and you had trouble getting recognized, had trouble cashing them for 100% in another town? This is the system that eliminated that. This is why you can write a check to a guy in Los Angeles for $1,000 and he will figure that you're good for it, even though you're in St. Louis. Now, what's happened is
the system is good for it. You may not be good for it as a person, but the banking system is good for it.
Right. Now, what's happened, of course, is over the late years, the number of checks has plummeted as other forms of payment has become more popular. But the Fed is involved in those too. The Fed clears all what are called ACH, automated clearinghouse transactions, which are transactions that are initiated electronically and then sent through a system to a clearinghouse that then sends them to the other bank. So an example of that is when you sign up for automatic pay for your gas bill. So what's happening there is every month the gas company is sending an ACH request to your bank. The bank is debiting your account and sending the money to the bank for the gas company, and that's all cleared through the Fed.
What about Venmo and Zelle? Is that regulated also?
So Venmo and Zelle are different. Venmo and Zelle are what are called peer-to-peer organizations, and they are not cleared through the Fed. Those are cleared through the fintech, and they are risky. Again, people don't appreciate this, but if somebody sends a Venmo to you, you may, and then it turns out that they try to revoke it, or that person's account didn't actually have any money in it, you're on the hook for that. There's no bank for you to go back to. So those transactions actually do have some risk, and those transactions also have a much higher rate of fraud because Venmo and Zelle are not nearly as cautious about knowing who they're dealing with as the banks are. However, it's much cheaper, much cheaper than it is to run a bank. Now, the other thing I want to mention is wire transfers, because the Fed has a big role in that. The Fed runs uh, a wire transfer system called FedWire, which makes essentially instantaneous transfers between banks at the request of customers. And then they also participate in what's called the CHIP system, which is the system that handles international wires, which is in Belgium, but has been used by the United States as a weapon by sanctioning countries by getting the Fed to tell the CHIPS people that these countries can't participate in the international financial system anymore. One of the biggest financial sanctions against Russia, for example, is that all the Russian banks were kicked off the chip system. So if you wanted to send a wire to a Russian bank today, you cannot do it from the U.S.
There's some of the law firms that do asset recovery, and I'm talking about some big names, actually send subpoenas to the chip system and to the SWIFT system to follow the transfer of money where it goes. That's one way that these, I say, high-priced debt collectors, go after the money. I don't say that in a condescending manner. I mean, it's just one vehicle they have to trace the money because everything's traceable at a certain point until somebody takes the cash and walks away with it.
Right. Well, payment systems are a major function of the Fed, but the payment system structure in the U.S. has been severely criticized, partially because of the Fed, but partially for other reasons too, as being very clunky and expensive. The Fed just started a new system called FedNow, which essentially is instantaneous. And that is still being trotted out on a pilot basis, but it's probably going to become more popular because everybody wants to settle everything more quickly now. And then the other problem, of course, is that what all these banks are afraid of is that all these transactions will become tokenized. And then instead of banks sending notes to each other, which is essentially what a wire transfer is, you have an electronic token that's just sent from me to you, and it'll never go through a bank. And then you'll send it to your
big concern for the banks. To me, it seems, and I agree with you. There's no protection. But Fred, there's something that's intriguing me about this. Okay, so I write a check to you in Pittsburgh. You're going to go for $1,000. You go to your bank and you cash it. Bank pays for it. But you're going to say, yeah, I just met Rudy. I don't know him. I'm going to wait 3 or 4 days before I cash a check because it might bounce. There was a scam going on targeting lawyers where a foreign company would say, we want to retain you. Here's $10,000 retainer, keep 2,500 and give us a back, and they end up taking money out. What is the time period in which to clear something that you can be absolutely safe?
Okay, so here's what happens. That is not actually a clearing issue. By the way, that is one of the most common internet scams, and it's shocking how many lawyers fall for it. But that's what's called funds availability. And the regulators require banks to have what's called a funds availability policy, which is a stated policy that describes when the bank has to give you credit for an item in your account. So if I take a check, let's take your example. If I take Mr. Internet's check for 50 grand and put it and deposit in my account, okay, and the bank sends it on to Tierra del Fuego, wherever the check is from. The bank has to give me credit the next day for that check. If it is an international check, it might be 2 days. But if in most cases, but it's provisional credit. You have access to the money, but if the check bounces, the bank still has the right to come back and charge the check against you. So you're at risk for that.
And so that's one situation where the bank wouldn't cover that fraud.
Not if the check bounced. No.
Yeah, if the check bounced, they wouldn't cover that. I mean, they would cover like fraud in a credit card or things like that. But
no, when you get credit the next day for a check, you're getting provisional credit. See, people think that banks take these checks and send them off to the other bank and sit there and think, oh, well, now we'll wait to hear back and make sure the check is good before we give the customer credit. That never happens. That never happens. What happens is the check gets sent off to the other bank and nobody ever hears about it again because everybody assumes the check is going to be good. The check being bad is the exception to the system. And that's why the funds availability problem requires funds to be made available the next day, because the system is running in the background, clearing the checks.
So if I want to scam the scammer and they send me the $50,000, okay, and he says, give me my money back, I'll say, no, I'm not going to give it back until your check clears.
Right. That's what you should do.
How long do I wait for the check to clear?
Well, it depends on when the check. It's again, let's make it a U.S. check because it's much more complicated with foreign checks. So typically, I mean, today paper checks don't move. Everything is done by image and computer, so it's overnight presentment. So let's say you deposit the check Monday, and the check is presented after banking hours on Monday night, so it hits the bank, it hits the payer bank on Tuesday. Typically, the bank has till midnight of the next banking day to accept or reject the check. So so the next banking day would be Wednesday. So let's say they take all that time and reject it Wednesday and then send it back to you. Your bank should get it Thursday. They should debit your account on Thursday and you'd find out Thursday or Friday. So 5 banking days is probably a reasonable time to wait for a check drawn on a US bank. See,
Yeah,
because if the payer bank rate waits too long, then when they send it back, your bank will say, oh no, we're not taking this. You waited too long. This is on you.
Okay.
Now, it's different if the check is phony. If it's a forged check or an altered check, then they have longer. But if it's just a bad check, they only have 2 days. They only have 2 days.
I know. I'm amazed at how many lawyers have fallen for that.
When I was at the bank, we had a number of claims like that, and I was very surprised at the identity of some of the lawyers who made the claims. That's all I'll say.
Right. We can't disclose names. We keep the names private to protect the innocent, right?
Right. So
Well,
the last function I want to talk about, Fed, is their data gathering function, because the Fed collects a tremendous amount of data. They publish this document every year, 10 times a year, called the Beige Book. And what this is a survey, this elaborate survey that hundreds and hundreds of people are involved in, done by all 12 Federal Reserve banks of the economic conditions in each region. And then they summarize those and put them in a book. And it's not statistics. It's all just talking to people about how things are going. And it's extremely valuable information. The Fed also publishes, however, lots of statistics. For example, they publish statistics on consumer credit. They publish statistics on industrial production. They publish statistics on the relative ease or tightness of lending conditions, many, many other things. They have a whole arm that does nothing but collect information. And they share this with their member banks, they share this with the public, and they share it with Congress. They're constantly writing reports to Congress with detailed information about the status of the financial system. So a whole big part of the Fed is just collecting information. So getting back to what you said earlier about, oh, well, do they just sit around and decide what the hell is, let's raise interest rates by a quarter point? It is a very complicated process involving hundreds and hundreds of people. I mean, I read the minutes of the Fed Open Market Committee. And as I said, the committee has 12 people, but they list all the people who are at the meeting. There's like 100 people at this meeting. There's all these economists. There's all these other people from the Fed. There's all these other specialists in banking. It is a very complicated discipline process.
Well, Fred, we're approaching the end of our presentation, and I want to thank you for this. Really opened my eyes a lot. For years I've seen news about the Federal Reserve, and all I thought they did was just have interest rates. So I'm going to say goodbye to my LinkedIn and YouTube audience. Thank you for joining. It's been great having Fred. And by the way, Fred is an expert witness. He is available. Litigation matters, non-litigation matters. So you all can reach out to Fred through his LinkedIn page. Thank you, Fred.
Thanks. This was a very interesting discussion.